Welcome to Uncaged, a show that celebrates thought leadership from today's top business leaders. The program provides a voice to amazing executives from around the globe who are shaping the world of business today and mapping the path to the commerce of tomorrow. Today, we're speaking with Larry Steinway. Hey, Larry, how are you?
Hello there. Good to see you.
It's great to have you on the show, Larry. Larry is the Senior Vice President of Mortgage Lending at Guaranteed Rate. He is one of the top 0.5% of loan officers in the United States. And so no surprise to any of you, we're going to be speaking about loans and mortgages in the real estate marketplace that we find ourselves in these days. But before we get there, Larry, tell us a little bit about yourself and your career.
Sure thing. So I grew up in the Chicagoland area, a suburb north of Chicago, the North Shore area called Northbrook. I have been doing mortgages. I'm in my 29th year, so
wow,
pretty much right out of college days. And this is all I know is mortgages for professionally. And I was originally the fourth loan officer hired by Guaranteed Rate 22 years ago. We are now one of the top 3, 4, depending on which way the wind's blowing, top mortgage companies in the United States. I've got a great team, an amazing team that's led to my success. I specialize just in residential lending, single family homes, condos, and then 2 to 4 unit properties. And it's been quite a ride, especially the last couple of years, and then sailing into this year. So
yeah, I mean, I'd say that if we were talking a couple of years back, Larry, you probably were saying, I'm sorry, babe, I can't talk. I'm so busy. I got 10 other deals going on right now. Now we find ourselves in a different market. I'm sure it's still buoyant, but certainly a tougher market. Tell us a little bit about what you're seeing out there right now.
Yeah, it's definitely a tough market. I wouldn't be telling the truth if I came out here and said it's rainbows and unicorns, which it was for 20 and 21. I mean, Listen, it was a horrible time in the globe with the pandemic taking place. And unfortunately, my industry is sort of reverse. When the world does well, we don't do well. And when the world doesn't do well, we flourish. And it's been that way. I've been through 3 or 4 cycles, the Great Recession in 08, 09. We thought that was rough. I will say this is a little rougher, this period. We're all kind of saying that a little bit. I think that, again, not to compare past history, but the spike in interest rates was really not expected to be as dramatic as it is right now. We thought we were going to go from 3% to 5%, 5.5%. If you would have told me that I was going to be over 7%, and then just 10 months ago, I was at 3%. That's one of the largest, fastest increases since they've really been charting these things in like 40 years, I think it is. So pretty crazy.
Well, I mean, I think it's funny because, when we think about recent memory, it's always been so low. But I remember my parents and their mortgage rate, I think, was like 18%. So, I mean, I'm an old guy, but back in the 70s. Yeah.
You look good for 75 years old there. You really do.
Exactly.
Keep doing whatever you're doing. That's my advice. So.
Sure, definitely. But I mean, obviously people are going to still buy and sell, Larry. They're still going to need stuff. So what are you guys doing to keep going and growing your business?
It really is true that old school tactics are still new school tactics. So what we're doing is, I'm blending with what got me to this successful point in the mortgage industry. I think I've done very well, but I'm far short of where I want to go. I'll tell you that. So what we're doing is we're leveraging technology, obviously, with the traditional methods, client management relationship, we really are really trying to, and I think the formal term is CRM, which is Client Relationship Manager, which is the name of the software, either or. We want to stay in touch with people. and how we stay in touch with them is what's changed a little bit. For example, you could send out a message to 100 people via text today, okay, with bulk texting. You used to not be able to do that. You had to sit there one individual, years ago. So we're doing that, but we're also still doing things which I do for any one of my clients. We get all their birthdays, we put them into our spreadsheet. We just want to send them a gift on their birthday, say thank you.
I like it.
It's old school, new school. And
I love that. There was a guy in the industry that I grew up in, which was advertising. He was a very successful executive in the media buying industry. The one thing that he did every day was that he would call you on your birthday. He had like a long list of every one of the people he was connected to, and he would call you on your birthday. And that honestly was like incredible. I mean, just
feel it.
Yeah, you being from Chicago and me being from Chicago, that's like Chicago politics right there. Those old school tactics are what kind of kept the daily machine going for many, many years.
I think evoking a positive emotion out of someone you want to work with can never be replaced. That's, it really is just tremendous value in that synergy.
Well, listen, Larry, I mean, if you put your Nostradamus hat on, I mean, one of the things I think that is tricky is that we look at today and we say, oh, wow, the rates are high.
Yeah.
But I mean, what do you think is going to happen? What's the trajectory for the next couple of years?
Well, I think we're going to probably go to 30% and Florida's going to fall in the ocean. But other than that, outside of that analogy that I read the other day, okay, listen, the Fed it's a strange thing. The Fed needs to hurt us to help us.
Mm-hmm.
So how do they help us? Well, they're going to put a lot of hurt in interest rates and slow things down. Okay.
Yeah.
I think we are going to see reduction in home values. Now, it varies from community to community. It's the United States is made up of a bunch of micro real estate markets. So what's happening in San Jose, California is not the same as in Chicago and not the same as in Miami. We're all in different markets. Typically the Midwest, in my specific marketplace, will not suffer as much in loss of value. We're expecting 3.5% reduction in overall home values in the Chicago market.
That's low. That's
low. And when you look at, unfortunately, I believe you are in the Florida area. I think
I'm in Miami. I would say that
they're talking 10-15% in some places.
Yeah, like I would say the last month we've seen 10% drops for sure. But I mean, if you look at the historic value increase though, on these properties, it's crazy. I mean, I'm looking at people that bought some of these places like 4 or 5 years ago, and they have it on the market now for almost 2.5 times the value of what they bought it for.
They bought a little condo for $400, and now they're selling it for $899.
Exactly. So, I mean, I'm sure someone's unhappy, but at the same time, I mean, that's a bubble, right? So I think it's going to normalize.
History repeats itself, because my parents built their home in 1970. For $58,000, and I think when it was sold just a few years ago, it was $500,000, let's say. Okay, just throwing some numbers out there. Think of that appreciation. And it happened again in this particular market. And I think the good news though is we're not going to see tremendous depreciation in value. I think it's temporary, but I do think that they're anticipating, based on Morningstar just did a review, Mark Zandi from Moody Analytics, they both had some reviews out, that they feel come next summer, like the July, August window, we're going to see the Fed pull back on interest rates as the expectation. We're definitely going to see a rise in unemployment, okay? Meta, Facebook, just announced today they're laying off 10,000 employees. We're starting to see the tech world soften up a little bit. I think once unemployment gets up there, we're at 3.7% right now. Once we get to about 4.2, 4.3, we're going to see the Fed probably taper off on their interest rate hikes. And then we're going to see rates come down a bit. It's going to cause a surge in buyers. They're going to say, hey, we got to get out there. That property we want to buy, it's now affordable again from 7% now down to 5.5 or 6. So there's one comment that I will say it. Excuse me if I'm dragging this topic out a little bit, but
no, it's good.
The big comment that we're saying and seeing in our industry is you marry the house, but you date the interest rate.
I love it. I love you.
That's a concept.
I love it. I mean, Larry, let me do a little bit of role playing then with that idea of marrying and dating.
Okay.
Imagine I am
my wife's watching this, by the way.
No worries. Nothing too racy here. But imagine that I am buying a home and I'm out there in the marketplace. What advice would you give me?
I would say that, listen, that based on what I just said, that we anticipate rates to come down end of next year. They anticipate it into 24 for sure, and even into 25. That there's a couple things. Number one, today's home that you buy will be more expensive next year and the year after, most likely. Okay. Now, it's more expensive to finance it today, but the actual home value we will see to rise, because when those rates start to come down, it's going to turn again into a passionate buyers out there saying they need to get into that market. So
right.
I would say to someone that, that home that you buy today will be more expensive a year and a half from now. Okay. So keep that as you shop. The other thing is there's new products out there that are very common. There's a product called a 2-1 buy down. More specifically, it's called a temporary 2-1 buy down. And I'm selling this now, and all the lenders are. One of our competitors calls it an inflation buster. It was on TV. I saw it the other day. So I'm not going to mention my competitors on this program.
Well, what's the 2-1 buy down?
Here's what it is. Let's say today's interest rate is 7%. Okay. If the seller makes a small subsidy, a contribution, typically 2.2% of the loan amount. So if you're borrowing $400,000, do the math with me. That's like $8,500 roughly. Okay. Yeah. So it's not exactly 2.2%. It's just sort of, there's a formula that we would give the customer, because a lot of sellers that have their home sitting on the market say, hey, you know what? Let's cut our price $30,000, $35,000 to spur more activity on our house. Okay. Right. So, well, the 2-1 buy down, the seller can just give an $8,500 credit per se. And now here's what happens. I'm the buyer. You're going to give me an $8,500 credit towards a 2-1 buy down. What does that mean? So if the interest rate's 7%, the first year, my mortgage will be at a rate of 5%. Okay. Typically, like on a $400,000 loan, I don't know, that could be almost $500-$600 less a month on the payment, which is a lot of money.
Yeah.
Nice car. Okay.
Yeah.
Covers the car. And so that year one, the money is drawn from a subsidy that the seller gave you at the time of closing. So, and then in year two, the rate goes from 5% to 6%. And then years 3 through 30, it's fully indexed at 7%.
Right.
A lot of people are taking this product under the premise,
that's hope, a great product.
I think they're going to refinance. If you're 5%, and all of a sudden,
because I would say, Larry, like that's what I'm thinking, which is, look, if you show the historical index of home ownership, assuming that that's going to continue in some form or fashion, owning a house is valuable. Yeah. Even the people that bought houses back in the 70s have made tons of money and, they were able to refinance along the way and bring it down. So in some ways, it blends out nicely. The nice thing about this product that you just mentioned actually is that it kind of softens the blow up front a little bit. So
it'll ease into it a bit. And I really do think that the people today that take those products, I mean, if they don't take that product, they're right where they'd end up anyways.
Yeah. So look, I mean, when you look out, Larry, into the future here, I mean, it's a great industry. You've been in the business, for a long time.
Yep.
What are you excited about in the future? What's on the horizon for us?
Fortunately, our business still requires the human role in it. It's not been replaced yet by a point and click system. It's the most important purchase a person will ever make in their lifetime. How often does somebody go spend $600,000, $700,000, $500,000, $800,000 on something? Okay. Right. So you might only do it a couple times in your life. So I'm excited that there's still a need for an expert in the field which gives me the feeling that our trade, our craft, our industry will always still provide an opportunity for people at my level and for the next young generation coming through. I'll never forget it. One thing, when I was thinking of going into the business, I was working at a retail sales job, and an elderly gentleman came in who said he sold mortgages in the 40s and the 50s. And he said to me, I said, well, I'm thinking of leaving. I'm going to go into the business. And he said, you know what, Larry, this is the most amazing thing about the business you're going into. People will always need to borrow money. It will never go out of style. It will not be the VHS tape and the Betamax players went away. DVD players went away, right? Okay. CD players are gone, but borrowing money will go on from now to the end of time.
Yeah, I mean, it's interesting. I spend a lot of time all around the world. The market we have in the US is certainly very robust when it comes to things like mortgages, and it's such a critical part of the economy. I can't imagine that it won't continue to play a critical role for sure. And I'm just hoping that it doesn't go too crazy as I consider to buy properties, down here in Miami. So every day I look at those prices coming down, and I'm hoping they come down a little bit more, so maybe I could buy a house. So
I think there's going to be a little more hurt before there's a little more happiness. I do. I really think we're about 6 months away from seeing the light at the end of the tunnel. I don't want to be pessimistic, gloom and doom, but it's still, again, people are buying, people are still doing things. They find the right home. You're also getting some values right now because so that's it.
So Larry, I mean, if someone wanted to learn more about what you and Guaranteed Rate are up to, where's the best place to reach you?
You can email me. It's real simple. Larry@rate.com. Larry@rate.com. Or they can give me a call at 773-435-7542.
Awesome.
They can go to my website, rate.com/Larry.
Awesome. What a great website. Yeah. Excellent. Well, we've been speaking with Larry Steinway, who is the Senior Vice President of Mortgage Lending at Guaranteed Rate. He's one of the top 5.5% of loan officers in the U.S. And we've been talking really about the real estate market, which has been extremely buoyant over the last several years. And now with high inflation, it's going into a new phase, one that you probably need a little bit more counsel if you're a buyer out there on how to tackle it appropriately. Larry, thank you so much for being on the Uncaged Show today, and we look forward to having you back.
Thank you for having me.
Cheers.
Cheers.